In this section, let's look at the most important building block in credit risk decisioning, credit score. Credit score is calculated from a credit scoring model or scorecard. These models are developed by statisticians or data scientists using different methodologies. Once developed, the scores are used by lenders to evaluate the borrower's creditworthiness. The scores are adopted widely throughout the whole credit life cycle. They are used in various credit decisions. We'll go through a few examples later in this section. Okay. Score to odds. This is a typical graph to show that what's the score's value corresponding to the odds. So what's the odds? Odds means the probability you have good accounts versus bad accounts at a particular score. For example, if you have odds of 10, okay, here, that means for every 10 good accounts, you have one bad account. Okay, so almost a 10% chance you have a bad account versus the 100. Also 100 means for every 100 good accounts, you have one bad account. So the risk is much lower, right? So close to 1%. So the line here is describing the score to odds relationship for a particular credit score. You can see the horizontal axis, the score value from below 600 all the way to above 800. The vertical axis, that's the good to bad odds. Once the scorecard is developed, the score can be aligned into this straight line. Here we have an example. If the score value is 675, okay, so it's corresponding to the odds of 30 to 1. So that means for all accounts score with a value of 675, the odds are for every 30 good accounts, there's one bad account. So this graph serves as a tool to illustrate quickly what's the risk level for each particular score value. Okay, so this is the score to odds relationship chart.